Hey everyone, welcome back to Corporate Decoder, the place where we decode the filings that shape our world, and sometimes we find a little something extra in there like some sweet new stock options. Today we are diving into a Form 8K from HeartSciences Inc. Now this isn't a full financial report like a 10Q or 10K, but it is still packed with important updates, especially concerning their executive compensation and stock plans. Stick around because we're going to unpack what this means for the company and its leaders. If you are new here and like getting straight talk on complex corporate moves without the jargon, make sure you subscribe. And if you enjoy more in-depth discussions and want to connect with like-minded finance enthusiasts, join our Discord community linked in the description below. Alright, let's get into it. First off, HeartSciences Inc., trading under the ticker symbol HSCs for their common stock and HSCSW for warrants. Both are listed on the Nasdaq Stock Market LLC. It is always good to know where a company's shares are traded. This filing is from the 28th of November 2025. And it tells us a few key things. The company is confirming its common stock and warrants are registered and traded on Nasdaq. Now, this might seem basic, but it is essential for understanding the company's public market presence and regulatory obligations. It also lays the groundwork for the rest of the report, which deals with equity and executive compensation. HeartSciences Inc. is also checking the box that says they are an emerging growth company. This means they can take advantage of certain relaxed regulations, which can be helpful for smaller, growing businesses. They've also chosen not to opt out of extended transition periods for new or revised financial accounting standards. This is a common move for emerging companies, allowing them more time to implement complex accounting rules. Now, this section is really just a pointer to another section saying that any unregistered sales of equity securities are detailed later. In simple terms, they're saying, if we sold any stock without registering it with the SEC, you'll find the details further down. They mention that these sales are exempt from normal registration rules, likely due to specific provisions of the Securities Act that allow for private placements or employee stock plans. This is where the meat of the report is. This section covers changes in directors and officers, and more importantly for us today, details about how the company is compensating its key people. The company's board of directors made an important decision on the 28th of November 2025. They approved Amendment Number 3 to their 2023 Equity Incentive Plan. Think of this plan as the company's way of giving out stock and stock options to incentivize employees and executives. The big change here is that they're increasing the total number of shares that can be issued under this plan. Previously, there was a limit, and now they've bumped it up to allow for the issuance of up to 125,000,000 shares of their common stock. What is interesting is the automatic increase clause. Starting in May of 2026, the number of shares available will go up each year. The increase will be the lesser of 25% of the total outstanding shares or a number determined by the plan administrator. This is a common strategy to ensure there are enough shares available for future grants as the company grows. However, this plan amendment still needs shareholder approval, which will happen at their next annual meeting. So while the board approved it, shareholders get the final say. Following that plan amendment, the board also approved granting restricted stock and restricted stock units, or RSUs, to certain executives, directors, and employees. These are collectively called equity awards. Let's look at who got what. Andrew Simpson, the Chief Executive Officer and Chairman of the Board, received 70,000 restricted shares of common stock. Mark Hills, the Chief Operating Officer, Secretary and Director, will receive 45,000 REs. Danielle Watson, the Chief Financial Officer, gets 15,000 REs, and each of the non-employee directors will also receive 15,000 RSEs. Now, how do these awards vest? Meaning, when do the executives actually get to keep them? For Mr. Simpson's restricted shares, they vest in full only after certain conditions are met. One key condition is the approval of the plan amendment we just talked about. Then, 1/3 of the shares vest after 1 year from the grant date, and after that, 1/12 vests every quarter for the next 2 years. So all of them should be fully vested 3 years from the grant date. This is assuming Mr. Simpson is still employed by the company and his employment agreement is in effect. Here is a significant detail. Mr. Simpson doesn't have to be employed on the vesting date if he is terminated by the company for any reason other than just cause, which is defined in his employment agreement. This is a pretty strong protection for him. Also, if there is a change of control meaning the company is bought or merged, 100% of his shares vest immediately. The answers for Mr. Hills and Miss Watson have a similar vesting schedule. 1/3 vest after 1 year and then 1/12 every quarter, with full vesting occurring 3 years from the grant date, provided they are still employed. Similar to Mr. Simpson, they're protected if terminated without just cause. For Mr. Hilds, a change of control also triggers immediate vesting. For Miss Watson, a change of control under the plan's definition will cause 100% of her ARSAs to vest. The ARSAs for the non-employee directors have an even quicker vesting schedule. Half of their ARSAs vest after 1 year. And then 1/8 vests every quarter, meaning all their ARSUs will fully vest 2 years from the grant date, as long as they are still serving on the board. A change of control also triggers immediate vesting for them. Here is a really interesting kicker. All these equity awards for everyone mentioned will immediately vest if the company hits $250,000 or more in revenue in any fiscal quarter after this report date. This is a powerful performance incentive. It ties a significant portion of their compensation directly to the company's top-line growth. Reaching $250,000 in quarterly revenue is a concrete financial milestone that shows the business is generating actual sales. Finally, under item 9.01, they list the exhibits filed with this report. The most important one here is Exhibit 10.1, which is the actual amendment number. 3 to the HeartSciences Inc. 2023 Equity Incentive Plan. This is the document that contains all the legalese and finer points of the plan amendment. They also have Exhibit 104, which is the cover page interactive data file, something that is becoming standard for modern SEC filings. Now let's put on our analysis hats. What does all this mean for HeartSciences and its investors? The amendment to the equity incentive plan, increasing the share pool, is a standard practice for growing companies. It is a necessary step to continue attracting and retaining talent. The fact that it needs shareholder approval is also normal and shows a commitment to corporate governance. The grants themselves are also typical for executive and director compensation. The vesting schedules are designed to encourage long-term commitment. We see a mix of time-based vesting and performance-based incentives, especially with the $250,000 revenue trigger. This revenue target is quite significant. If they can consistently hit that number quarter over quarter, it would signal a substantial shift in their business trajectory and could lead to significant positive price action for the stock. However, we have to consider the risks. While the increase in shares is needed for growth, it also means potential dilution for existing shareholders if not managed carefully. The performance vesting trigger of $250,000 in quarterly revenue is a clear indicator that the company is focused on sales generation. If they struggle to meet this target, the executives' awards won't vest as quickly and it could signal underlying business challenges. The provisions around termination without just cause for executives are quite favorable to them. This means that even if things don't work out, they could still be eligible for full vesting of their awards in certain scenarios, which is something shareholders should keep an eye on. Overall, HeartSciences Inc. seems to be taking proactive steps to align executive interests with company performance, particularly revenue growth. The amendment to the equity plan and the specific grants suggest a strategy focused on incentivizing key personnel to drive sales. The ultimate success will depend on whether they can consistently achieve those revenue milestones. If they can, this could be a strong signal of future growth. If not, the potential dilution from the increased share pool without corresponding performance might be a concern. Alright, that is our breakdown of HeartSciences Inc.'s latest filing. What is your take on these equity awards and that revenue target? Do you think it is a smart move by the company? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And of course, subscribe for more deep dives into corporate filings. Don't forget to check out our Discord for more discussions. Thanks for watching, and we'll see you next time.